Good afternoon, Tina Mitchell here, your local mortgage expert with today's Mortgage Minutes. Today I want to talk about interest rates, what's happening with mortgage interest rates, what the Feds have done, how that's affecting the markets, and the liquidity issues that we're having with banks. So I'd like to give a visual of how the Fannie Mae 30-year bond is trading. Mortgage interest rates are directly tied to how the Fannie Mae bond is trading. They're not directly tied to what the Feds are doing with the Fed's fund rate, which is directly tied to what happens with the prime rate. That is indicators of short-term lending, credit cards, car loans, home equity line of credits, but mortgage rates are not directly tied to prime. They're impacted based on what the Feds do, just like all the markets are, but they're not directly tied. They're actually directly tied to the Fannie Mae 30-year bond. So when the Fannie Mae 30-year bond drops in trading price, that is bad for mortgage interest rates, and they are increasing. When the Fannie Mae 30-year bond increases in trading price, that's good for mortgage interest rates. So interest rates are going down. Now, as you can see, just in the last few days, the large swings that we've seen from one day to the next, which is not normally how you see the bond market trading. Now, this is where the issue is coming in with liquidity for banks. So let's first talk about the Feds and what the Feds did. The Feds were scheduled to meet yesterday and today, but they had an emergency meeting. They couldn't wait 48 hours, so they met on Sunday, March 15th. And they had made the decision to use the 100 basis points that they had left to lower the Fed's fund rate. This is the cost for banks to borrow overnight from each other. So the last time they dropped 50 basis points, it dropped to 1 to 1.25. Now they use the 100 basis points that they had remaining to drop it to 0 to 1/4. Now, this doesn't mean that prime rate, the money that you are, the interest that you're charged, because there has to be a margin there for the banks to make money when they lend you money, correct? So the prime rate is typically 3% higher than what the Fed fund rate is. So they dropped it to 0 to 1/4, which means prime right now today is at 3.25. Now, again, what's happening with prime does not directly affect mortgage interest rates. As you can see from that chart, the mortgage interest rates have been all over because they're attached to the Fannie Mae 30-year bond. Now, will the Feds drop into a negative? I don't think so, because it would hurt the banking system like it did in Japan, but we'll have to wait and see how this plays out. So the reason the Fed is doing this is because of liquidity issues. Now, also what the Feds did is they reinstituted quantitative easing, QE. If you were around watching the markets and hearing what was happening in the financial meltdown, that's where you would have heard of QE. So they reinstated that, which means they purchased $700 billion in treasuries and mortgage bonds. $500 trillion went to purchase treasuries, and $200 billion would be purchasing mortgage bonds. Now, they immediately started with 40 million. Now, most important was to stop the runoff of assets from mortgage-backed securities. So all of the loans, when they close, would run off of their balance sheet and they've received cash, but now instead they're repurchasing the mortgage-backed securities. Now, the Fed wanted to do more to help with the liquidity issue. In the financial meltdown through the Dodd-Frank Act, there was a reserve requirement put in for banks. They were required to hold on to 10% of your deposit. So anything that you deposited into the bank, they would need to hold on to 10% of that for reserves. Well, the Feds removed that. So now it's at 0. The reason they removed it is because consumers are coming in and they're wanting money. They want money for a down payment, where they were thinking of selling stock, but because the stock market tanked, they're taking money out of the bank for the down payment. They have margin calls and investments that they make because of the drastic swings in the stock market, which we're going to get back to margin calls in just a second here. Taxes are due, annual taxes, quarterly taxes. There's a lot of reasons that people are going into the bank to get their money. And I mentioned in my last video that it's similar to It's a Wonderful Life, the run on the bank. Now, it's similar and compared to that, but it's not the same, not as drastic because of the infrastructure that we have today. But the Feds again cut the requirement down to 0. Now there is 11 trillion in mortgages, half of those eligible for refinances. Now in a great market, banks might be lending 3 trillion a year in purchases and refinances. But now there's 5 trillion in just a month that they're lending. So going from a great year of 3 trillion to 5 trillion in just a month. Now I'm going to share why this is causing a liquidity issue with the banks. So when you lock in your interest rate, let's say you locked in when they hit historical lows at 3%. You cannot get a 3% interest rate today. Maybe they'll come back, but on a 30-year fix, you could have locked in at a 3% interest rate, which historical lows, lower than they were in the financial meltdown. Now you're guaranteed that rate, you're locked, but the bank is not getting that guaranteed price when they sell in the secondary market. They're going to get the price at the time that your mortgage closes. 30 days, 45 days, 60 days, lenders are taking longer to close because of the capacity issue that they have. So they have to hedge for what the market is going to do at the time that your loan closes. So when it closes, if the interest rate was 4.5% and you locked at 3%, that's a lot of lost income there, correct? So what the banks do in a normal market, it's gonna wash itself out. You know, mortgages are closing, they're hedging, and the market is dropping, so they're making more, or the market goes up and they make less. But here's what they actually also do, is they invest in other investments, kind of like an insurance. The other investments that they invest in trade opposite of the bond market. So when the bond market drops in trading price, again, mortgage rates go up. These other investments that they invested in, while mortgage rates are going up, bond market is dropping in trading price. This other investment is gaining in trading price because it works opposite. So it gives like an insurance for the hedging. So that's all sounds great, right? But here's what's happening right now with these big swings up and down with how the Fannie Mae 30-year bond is trading. When mortgage rates go down, so the bond market trades higher, mortgage rates go down. Remember I showed you that chart. There's been drastic change. What happens with the other investment? Well, being that the other investment trades opposite, now it's lost on its investment. But here's even worse, because of the big swing, the investment actually is now less than when they purchased it. So now the bank has margin calls. But the problem is those refinances have not closed yet. Because again, in a normal market, you don't see these large swings all within a few days. So their margin calls are coming, and that's where the liquidity issue comes in. So there's many reasons for the liquidity issue that we just talked about. There's billions that are being lost in servicing runoff. So you had a loan at one bank and then you refinance to another bank, and so they're losing servicing, and this is their monthly, the residual income that just keeps coming in, but they're losing a lot of that. And their refinances that are coming in to offset that have not closed yet. There hasn't been enough time for those to go through the process. They're having capacity issues. They just can't hire enough. They're paying overtime for their employees to try to close the refinances and the loans that they have. They're having to do lock extensions, which are costing them money because they guarantee a particular rate at a lock period, but they can't fulfill that time. So they're doing locking concessions, which means that's more money that's lost. And then the big issue are the margin calls. So understand a little bit behind the why of what's happening, because yesterday when the bond market improved by almost over 160 basis points, normally being that mortgage rates are directly tied to how the Fannie Mae 30-year bond is trading, you would have seen a big decrease in interest rates. But there wasn't a big decrease in interest rates because the banks are having to increase their margins because they have to make up the money because of the fact of the margin calls or the liquidity issues that are coming up for the reasons that I mentioned. So it's just really interesting to see what's happening and to see what is coming, moving forward, how the feds are going to deal with the liquidity issue that the banks have. We're going to get through it because we always do. But I just wanted to share mortgage minutes of the why behind what's happening. Interest rates are still very low. They're just not as low as what they used to be. Will they come back? Maybe, maybe not. But a call to action, if it does make sense for you, lock in your interest rate. If it makes sense for you to purchase a home, purchase a home. And just know that we're nowhere near what the average of interest rates are. We're still in historical low. That's just a little bit about what's happening with mortgage interest rates, what the feds are doing, how it's affecting everything else in all the other markets. And I'm here if there's any questions or a service that I can be to you, please feel free to reach out to me. And I want to thank you for listening today. This is Tina Mitchell with your Mortgage Minutes. And be safe and be healthy. Okay, thank you. Bye.